Hello everyone, and welcome to Jim Dalton's presentation as a month's review in the summer webinar series review and a question and answer. It is June 26th, 2014, and it's 4:15 Eastern. We'll go till about 5:30 Eastern, and as always, questions, type them in, we'll get to them, and if we can't, please feel free to call us or email. And Jim and I want to thank everyone for being here. We have a full house. And it's great to see you all, and we appreciate you taking time out from your day to hear Jim's work and hear a little bit about what we do. So with that, enjoy the presentation. It is being recorded, so you can go back and review it or hand it over to a friend. And with that, let me please introduce Mr. Jim Dalton.
Julia, thank you. All right, let me go to my first slide and hope this is working for me right now. It went one slide too far. Okay, the first slide, and I know this is a little bit small, but I want to cover something that I hear a lot of people, and particularly chat rooms, giving wrong answers to.
Jim, excuse me one second.
Yes.
Can you make it bigger? Just click from current slide on the panels above. From current slide, right up there near, yeah.
Okay, thank you. Okay, what we are looking at are market moves following two central bank announcements. Now, it doesn't have to be central bank announcements, but this is the last two times it has happened. On the far left, you see the spike following an ECB announcement. The market spikes up, and then you can see it trades around for a while, makes a new all-time high, then it comes back down through that spike. Now, what I really want to talk about, and where the misunderstanding comes in, is on the spike portion itself, the thin portion in here. What I say to people is on day one, on the day of the spike, and the day or two following that spike, it is very unlikely that the market is going to retrace much of the range. So on the day of the spike, these single prints are very solid, and they're usually pretty solid the day following or 2 days following. The following is where the misinformation is coming out. And what I have written very often is if the market then starts to correct, the odds are that it will come back through this spike very quickly, because there's no real trading or elevator type of supports in there to slow it down. What I'm hearing, questions I get from people, and what I'm hearing from things that are being said in some of the chat rooms, is that these spikes act as support. And what I'm saying, it may act as support on day one or two, but it doesn't act as support going forward. As you can see, we had one day it retraced all of this range. Then the market went higher. But this did not serve as support. It came down there. I had written the night before in the report, if we came down there, it could move very quickly because this does not provide support. You will look at, on the far right, you will look at the most recent announcement from the FOMC, and following that day of the announcement, the market was very similar to was the ECB. Traders get all emotional. The market goes up, and then a few days later, we come back through that spike pretty easily. We came back through it just the other day, and we came fairly easily through the spike simply from the fact that that spike does not act as support. So it is a question of timing. What it serves as on the first day or two that it happens, it's showing you how much emotion and how much enthusiasm there is. That's an emotional reaction. However, very little trading takes place in those spikes because price has moved through there very rapidly. So when the market comes back down, because there's been very limited trading, it doesn't do a good job acting in support, and it very often will drop through there very quickly. Now, before we move to the next slide, Julia, I want to take any questions that are relevant to what I have just talked about. Julia, are you there? Hello? Have I lost
Sorry about
contact?
that. No, I'm fine, Jim.
Oh.
It's me. I
okay.
had clicked the mute button somewhere else.
I just want to take any questions related to what I just talked about.
This is a good question. Single prints and spikes are the same?
No, it is a good question. This is a spike, but it's a single. This is a whole different animal. This isn't like an end of the day spike. So single prints in spikes and single prints that are on day time frame profiles are entirely different. You know, they should be watched more closely because they are a sign of where something, where there was excess on the day before. But it's not the same as this. Okay?
Thank you, Jim. Now, there's a question or a statement. The body of the spike didn't act as support, but the bottom is like a magnet or a destination, or as Jim would refer to that, the base of the spike.
The base, yeah, the base, I call the base of this support. And really what we're dealing with some of the market, this is the ECB announcement. What happened here? Something changed dramatically at this level. The same thing following the FOMC meeting. Something changed in the market right there. So this is a sign of change. When we came back through this one, you can see we came back through it, got rejected out, so we had a downside breakout failure, and then the market one time frame for 6 or 7 days higher. Now the current base of this spike, we came close to it. We came in the overnight market. We came within a tick of it the other day, and we went down and traded back through it this morning. But we got rejected out. So the base of that spike, or the base of, this takeoff following, these central bank announcements, and it could be anything else. I just happen to use these here. It is a reference. It's like a magnet because it is a moment. Represents a moment where change took place in the marketplace, and trading is really about change. Okay, additional question related to what we've been talking about. Julia, you there?
Yes, sir.
Oh.
Could Jim please go over what he calls anomalies?
No, I only want, right now, all I want to talk about is questions relative to what is in these two breakouts here. And then we'll go on and we'll take other questions down the road.
Okay.
Go ahead.
Can you expect to get support when price reaches down to the base of the spike?
It's like any other support. You look to see what it's going to do at that level. Normally, it's like any other support level or level where change took place. Normally, the first time down there, you will get a bounce. The second time down, it's much less likely to hold. What I wrote here, this is where we were following yesterday's close. Okay.
Pardon me, Mr. Dalton, this is as of Wednesday's trade. He's pointing to Wednesday, the last profile on that chart.
That's Wednesday. Okay, so what I wrote for this morning, and those people that have signed up for the intensive are getting the daily reports. So what I wrote is we were down there once. The second, and you normally, when you have a significant reference, and this is a significant, don't ask me what did that, I don't know. When you have a significant reference, and this does qualify as a significant reference, The first time down, the odds are very high that it will hold. The second time down, the odds are less. We came down through this morning. We came down a few ticks below this, and then we got rejected out. So it does serve as a reference. It's a level where change has taken place in the marketplace. So it is, but it's like any other support. The support hold, or is it violated? Another question.
Thank you, sir. Would you apply this to oil inventory and oil trade?
I haven't traded oil recently, but in the past I have traded several of the grains. I've traded several of the oil products and bonds, and I have used these concepts repeatedly over the years. Now, everything still has to, I mean, you still have to look at the context around which it is based, and that, of course, can change. But, you know, I'm really looking here, but in the past, I have used it for all significant announcements that have a care. What I'm really looking for is something that gets a very emotional, knee-jerk reaction upon the announcement. Okay?
Thank you, sir. What does Jim think now that the 1937 level, the base of the spike, has been clearly rejected the last 2 days?
It's like any support. It's been rejected from that level. Now remember, we were down. We were yesterday. The overnight market went to the exact tick or one tick above it and bounced. So we really didn't get down there in the daytime frame. It was the overnight market. Today was the first time down in the pit session. I mean, the pit session got close yesterday. So now it still acts as a level. Still acts as a level of support. The more times you trade there, it's like the semi-permeable membrane. The more times you punch a semi-permeable membrane, the greater the odds are that it's going to give way on, the odds are greater on each succeeding push on that membrane. Okay? So one more question and we'll go on to the next slide.
Great. Thank you, Jim. Hold on. Is the FOMC day the low of that day, which was made after the FOMC announcement, really one? Significant to you? Is that where change first took place on that day?
I don't think so. You know, you can always debate it because it did. The market went down, it went up, it came down, it went up. But I really took this level because we had a top right in here. So we had a little balance in here. We re-entered this balance. So I'm really going to count this level at the 1937 level is what I am using. That doesn't mean that, you know, that doesn't mean I'm right. It could well be this day. But if we get down to this low, which was the low on Fed day, they're pretty serious. Something has changed. So, like I say, this is like a semi-permeable membrane. It provides less support each time you get down to it. And if you get down to it, one of the things I wrote the other night, I don't know if I wrote it or was just making my own notes, down in here, if you get down through there, you get the possibility of the firecracker effect. And the firecracker effect is when you get down there, you trigger these stops, which trigger these stops, which trigger these stops, which can trigger these stops. So, I mean, that's something that you have to keep an eye on. If the market gets back down in here, clearly something has changed. Right now, the market hasn't decided if we really have change relevant to after the FOMC meeting. You know, we have to get accepted down in here to have pretty good evidence that we have changed. Once we get in here, then I think that the destination trade becomes probably down to the bottom of these 4 or 5 days. All right. Should I go on to the next slide?
Oh, just a quick comment that for anyone, you know, who hasn't watched the DVDs or listened to Jim, the firecracker effect is in play because those lows are pretty tightly knit together there. So once the stops are triggered from one low, it tags the next low, which triggers those stops. So just so there's no confusion about what sets up a quote firecracker effect.
And incidentally, you will sometimes see this occur in the day time frame when you'll have 3 or 4 or 5 bars that are one time framing higher, but each bar is coming down within a tick or two of the previous bar. Sometimes you get a liquidating break that takes all of those bars out at one time. Just because you have the potential doesn't mean it's going to happen, but it's certainly something that you want to be aware of.
Mm-hmm.
Okay?
And I know we've spent time here, but Sal's asking a pretty good question. How do you determine when these impulse moves, after the ECB and the FOMC announcements are exhausted? And I know that's an open-ended question, but if you talked a lot about the semi-permeable membrane, and once you're down there more, you don't know. But when would you know they're exhausted?
You don't. Here's an excess high here. You got an excess high. Okay, it was a new all-time high at that point in time. Now you start to get evidence of it. This was not elongated here. This day was not elongated. This was not elongated.
And so we had the gap that was unfilled from the Fed day, the European Central Bank day.
So you're getting this idea that this is getting very heavy. These are what I call the laggards are in the market. And that's why it's very important to understand the laggards. But remember, there's so many people that just trade price. And their little price meters are showing momentum is higher. So, you get this, you get less and less people. They still got buyers, but you're not getting this elongation. You're not getting the volume to go with it. You finally get the excess high or the completion at that point in time. Then you get a reversal on a short-term correction auction. Recently, and we're gonna talk about the recent high in the next slide, but it's the same thing. You go up until you get the exhaustion. Okay, I move to the next slide. Okay, this is an in-between slide. This is not. I forgot which slide was next. This is to make a separate point. We're going to go to another slide in just a little while that's going to show another exhaustive top and talk about that. But what I want to show you here, so the profile can help show you what to do, but it can also help show you what not to do. And what I've titled this, Approximating the Odds. Trading is so much about getting the odds or the edge in your favor. Now, consistently, I have people look at me and shake their heads, say, "Oh, Jim, I don't know anything about odds. I don't know anything about math, and that's what you're talking about. That's pretty abstract." And my answer to that is no. We think in terms of odds all the time. If you have to go pick somebody up at the airport near your local town, you're automatically thinking about odds. Okay, what time do I have to leave to get there and pick them up on time? Is there construction going on the road? Am I at rush hour traffic? I am not at rush hour traffic. We are constantly working with and approximating the odds of doing something. Most people will tell you, and what I've said before, is that trading is so much about odds, and we read a lot of books on psychology that tell us that the human mind is very poor at odds, that it's not mathematically set up to calculate odds. And I bought that the first time I read it. But as I thought about it going forward, I said that's not true. We are, as humans, we are constantly approximating the odds. Do we know exactly? No. The simple example I use, I get scientists to tell me, "Jim, if you can't tell me the exact odds, it's not relevant." I said, well, if I'm driving my car on ice or I'm driving on dry pavement, I don't have to know the exact odds to know that my odds of driving on ice are a lot higher than I'm going to have an accident or have a problem. And I think we do that all the time. So I think it's natural to us to think in terms of approximating odds. Now, what I want to do, I want to jump forward, and I want to show you how we use the structure of the profile to make some of those approximations. Yesterday, the market was trying to rally from the opening bell. And you see that the shape here, we're 3, 4, 5, 6, 7 wide right here. Now somebody asked about anomalies earlier. This is an anomaly. This is an anomaly. This is an anomaly. Anomaly is kind of a rough edge to the profile. It's an unnatural feeling. Forcing action tends to give you anomalies. In other words, in this case, the anomalies are left as the market is trying to go higher. So in this case, the market is not doing a good job of going higher. It's being forced higher by basically short covering. And you're going to see it a little later slide. Following the pit session on Tuesday and following the overnight inventory, well, following the pit session, and you'll see it a little bit later, but I wrote a note and I said, caution. Technicians may get all excited because we had an outside day to the downside. And I said, be very careful because I'm not so sure that's relevant. And you'll see the reasons a little later on why I thought this market might be too short. And I'm going to get to that in another slide. But coming into yesterday, I had written I thought the market might be too short. That's why I issued the caution. Secondly, overnight inventory was short. There was the settle. The green circle is the settle. So the overnight inventory was net short. And we have seen, I would guess that when we did the 60-day intensive, Julia tracked the number of times that we had counter auctions to the overnight inventory, meaning auctions that reverse of what overnight inventory was. And it was 65%. Over the past 3 or 4 weeks, we are running almost 100%. The only day that I remembered we didn't have some kind of counter auction was on the last, the day when the employment report came out. But this is an example yesterday. You see just before the market opens, they're still selling price off. And I'm going to come back to that in a second. The market opens and we rally throughout the day. Now this rally, the early portion of this moved, there's the A period, goes up to here. A period moved very rapidly in time. When something moves very rapidly in time, that is usually an indication. If it's going up, it's short covering. If it's on the downside, it is normally liquidation. That means it's short covering versus a more potent combination of new money buying and short covering. So when you look at this, yesterday the market rallied, left an anomaly here. In other words, it's not smooth, it's jagged. Another anomaly here. For those who are trading the S&Ps, late in the day, M period, MNL, late in the day, the market was still trying to stretch to the upside. When I looked at these anomalies, even though price is up here fairly late in the session, okay, there's only N follows that. Up here, the market was telling me, so when I say approximating the odds, the market was telling me that the odds of remaining with a long position were very poor, even though the market was making new highs here just shortly before the close. I was getting that information from the anomaly down here, from the anomaly here, not just the anomalies, but the overall shape or lack of elongation of the profile. So the profile can help show you help show you what to do, but it also can show you what not to do. Late yesterday, the market was really stretching to the upside. And at this point in time, I said, okay, don't want to be any longs, and I bought a little bit of a short position. And the market late in the day, I mean, you can say, well, it's crazy. But it was just an odds type of thing because this was really stretched out. And as you can see, that's what happened. It got pulled back. Now, if this market's going to go higher, what you want to see is you want to see this market elongate out. You don't want to see it 3, 4, 5, 7 wide here and 4, 5 wide here. You want to see more symmetry as the market's going higher. So if you saw more symmetry, you got a little better idea that the buying it's a healthier type of buying. When you get anomalies, it's normally forced buying. What is forced buying if the market's going up? It's probably short covering. Once short covering is complete, does that strengthen or weaken a market? It weakens a market because once the short interest is out of there, the potential buying power is out of the marketplace. Now, why some of this is so important is that these are the things, being able to read structure, think in terms of odds, or at least approximating odds, this is what will give you an edge in trading. These are things that you don't see most places. You don't see them written. You see buy here, sell here, but you don't see ways to calculate the odds. So even if this would have closed on the high, it was still poor odds for continuation, and you want to be out of the market. If this was a little more elongated, you might be more comfortable staying with that position. Julia, I'm guessing you've got some questions since I heard you.
I do, sir. No, and also we know too, it's not just the structure of the profile and the anomalous, the anomalies and the lack of elongation, but we also know from the day prior. So it's not just one data observation. That's where Jim's process can get a little more contextual, where we know the market was short from Tuesday's late break. We know it was short in the overnight. We see the opening drive off on Wednesday morning, and we know that the shorts are in trouble. So it's not just this. I mean, I know that Jim knows this, obviously, and many do out there listening, but it's just important to remember the context of this particular profile Jim is focusing on and the anomalies, that what sets it up. You know, as Jim says, what happens before has a lot to do with how things play out going forward.
And this is why I said that we issued a statement on the 24th. We issued a statement, said warning, as I think I said this earlier, warning, technicians may be excited because it's an outside day to the downside, and I think, oh boy, there's going to be downside continuation, and I put a warning out. We're going to talk more about that in the next slide. But, you know, Julia's absolutely right. It's like playing blackjack in Las Vegas, where you're playing with a single deck and you can count the cards. What has been played before has a lot to say about the outcome of the game going forward. And I have consistently said that trading is a game. There's a lot of gamesmanship in here. Okay, so I really wanted to show this slide to show you that you can use this information to have some idea what not to do as well as what to do. Julia.
Yes, Nedza, this is a good question. Those anomalies, are they a signal to you that price will revisit them?
They obviously, let's rephrase it. Are they a signal that price will revisit them, or is it better to say the odds have increased that price will revisit those anomalies? Those are quite different, because what happens, one of the things that gets traders in trouble, they will see these anomalies, and as soon as they see the anomaly, they start wanting to fade the market, expecting to go back down to those anomalies immediately. You have to look at the trend, you have to look at the context. I get tired of saying this and I feel a little funny, but we've talked before about, and it's on the live market seminar that we recorded in Chicago, and that's when we talked about where I walked in on the last day and said, be careful, this may be one of these days that opens weak and closes strong, and we got the 400-point rally in the last hour of trade. Now, the reason I'm bringing that up again, there were anomalies that went back 3 or 4 days in the market. And now, did it revisit it revisited all those anomalies. However, it was 4 days later, 5 days later in some cases. So the problem with traders, and like short covering, they'll see a market short covering and they have the P formation. Oh, I've got to short the market. They think that means they have to act on it immediately. It's a sign that you say, okay, we're getting short covering in the market. You don't know if that short covering has been completed. One of the important things to any auction is the completion of the existing auction before you start to get the counter auction. Julia, other questions?
I just will add to that too that sometimes, I mean, Jim's concepts and the way we use the profile it's pretty novel, and we'll start to see things setting up. But the rest of the market doesn't see it yet. Momentum traders are still press, press, press. Other traders, it's just not revealing itself. And people, it takes, sometimes with momentum, it's like turning a ship in a harbor. To flip that thing, it takes time to shift the sentiment and all the other, things going on to move price higher. So we have to be careful. I know I've had to learn over the years to, you see it, but then before fading it, make sure that some type of market-generated information is suggesting that perhaps it's now almost time. Because I know I tend to be early because of what Jim's taught me with, anomalies and structure and inventory and keeping the time frame straight. So that's just something I wanted to throw out there for everyone.
Good. And we're going to cover a lot of that on the next slide too. In fact, I think, and let me take one more question here, then I'll move to the next slide because there's a tremendous amount of information in there.
Okay, well, here's two quick ones, if you could, sir. Can you explain briefly again how short covering weakens the market? It basically removes buy orders from the market because shorts have to cover to cover their short positions. They take the buys, they buy, and they take buying power out of the market. But go ahead, Jim. I'm just trying to be quick.
That's exactly right. No, that's exactly right. Thank you. It's as simple as that. The only way you can get out of a short position is you have to buy. So once a short covering, that buying power has been removed. Julia's absolutely right.
So it weakens the market going forward. And this is where Jim's...
Let me rephrase it. It has the potential to weaken the market going forward because the support that would be offered by the short market participants is no longer there. It doesn't have to weaken the market, but the potential for it to weaken the market because some of that support is there if the market were to break. You won't have people buying to cover.
And again, if we could take that a step further, this is another concept that Jim talks about that, to me when I started it was kind of like the odds. It was like Chinese to me. I could not understand it. But the time frames, that short covering is a day time frame or a very short term normally situation. We see inventory imbalances all the time, short covering rallies, long liquidation breaks. But then in the next higher time frame, there's a different game going on or a different trend evolving from that. So,
But you can have short covering that takes place in the day time frame. You can have short covering or long liquidation that takes place in the longest of time frames. Here, a year or so ago, we had horrendous liquidation in the bond market. And it was just all these bond traders had gotten too long, and you had basically 2 months of liquidation from the bond market that had gotten too long, buy and hold, and they just got murdered in there. So the same concepts we talk about for the shortest of time frames are applicable to the longest of time frames. It's just obviously they're going to happen much faster in the shortest time frames. They're going to evolve much more slowly the longer the time frame is. But when it happens, it is the same concept. Everything we talk about is the same for every time frame we talk about, with the exception of the scalper. That's just a whole different business.
Right. And for instance, today with the profile we're looking at now, well, the market was attempting to go higher all day. Granted, was it successful in how successful is it in its attempt to do that? That's from Mind Over Markets. But, obviously the day time frame is up, 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 but the next higher time frame could be using this opportunity to sell into it. So this is where you start to see the overlap of time frames, and it just is a matter of thinking about it in terms of time frames as you're walking through Mr. Dalton's methodology, and always having that in the back of, just thinking about who's participating and how is each time frame fitting into your your picture.
As we go, after we do the next slide, we'll go to the current market. And you're going to see with this formation from yesterday, I believe, had a lot to do with the early break this morning. Because all this short interest was removed yesterday. And not only was the short interest removed, the market probably got themselves a little bit too long. They went from too short to too long. And I'm guessing that an awful lot of the break today that came early on and took out this low was telegraphed, the potential for it was telegraphed from the shape of yesterday's profile. And we'll see that before we end up today. Okay?
Okay.
I'm going to the next slide.
Yes. But I guess there was one thing I wanted. I beg your pardon, everyone. Okay, just someone's asking about anomalies. I'm having a tough time understanding them. It's not really, it's just look for jagged edges in the profile. There's not a lot of symmetry. And prominent points of control is very prominent, and as we've heard them called by other traders, naked points of control. They will tend to be revisited. They will tend to show just forcing action that really wasn't conviction in directional move, but rather just a hesitancy and a stutter stepping that tends to
stutter step. When you look at this market going up yesterday, if this market was smooth, if you had a smooth, remember, it's a continuous two-way auction process. If you had smooth, continuous two-way auction process with the market eventually working itself higher yesterday, it would have been much smoother along here. When you see these jagged edges, a lot of times, the market's going higher, but it's not smooth. There's not people that are willingly buying. And who doesn't willingly buy? The shorts. They're reluctant to cover. Remember, this day there were a lot of traders that said this, they were just so excited that this was, in technical terms, this was an outside day to the downside. A lot of traders got short, no thinking, technical thing, boy, that's big, I'm going short, I'm going home, we're going to get continuation. And they were forced to cover all day long, very reluctantly, because they still have it in their head, but this was an outside day to the downside, but this was an outside day to the downside. The more the market went, the more they had to cover. They were forcing, they weren't doing it willingly. That's why you get anomalies. Okay, I'm going to go on to the next slide.
Great, thank you, Jim. Okay.
Okay, now, first, the process, what I'm going to do here, I'm going to just make you aware of some information that we're going to go back over with the actual profiles in front of us. But I want to review this first, then I want to go to the profile. And I titled this slide, The Complexity of Putting It All Together. And this is for June 24th. This was the day that was the outside day to the downside. First point, carrying information forward. The overnight high was made during an electronic session. And what that really should say is the all-time high was made last Sunday night during an electronic session. So what? What we have talked about and what you see from observing markets, it is very rare when an auction completion for a long-term auction high or a long-term auction low is made in the overnight electronic market. So carrying that information forward, we had a pretty good idea that that was going to be revisited. Carrying information forward, Tuesday's low matched Monday's low. So what? Well, what it was, when Tuesday started, it rallied to the upside first before we got the outside day. It tagged, Tuesday's low tagged Monday's low. If you put those two profiles together, that is not a good, secure low. What you had buying there, and it went a long way, but more than likely it was either short covering or short-term money, not new longer-term money. Longer-term money doesn't wait for the exact low of the previous day to buy. So that was information I recorded early and took home with me, or took to the rest of the day. Carrying information forward, Friday and Monday's highs were matching. Again, so what? We saw, and you'll see it when we get to the profiles, we had matching highs on Friday and Monday. Both of the highs in themselves were poor, plus you put the two together, they matched. Well, what does it tell you? When there's no excess on the top, no single prints on the top, and they're matching highs, it tells you that the odds of that auction to the upside being completed are very low. Now, what will mess traders up a lot of times, you see you got a poor high on Friday, a poor high on Monday, and you put the two together and they match, it is really a poor high. And so what happens? Why do you get that? Sometimes you get that because the market got too long. Market inventory in the hands of short-term traders got too long, and the market has to take care of current business first. Sometimes a market has to break before it can rally. In other words, it has to break, it has to get the weakest hands out, and it's got to replace it with stronger hands. Complex, but yes, that happens all the time. When we're going to go to the next slide, and then Julia is going to play back in high speed till we get to that one point, going to play back the 24th. The market had a very difficult time taking out the matching highs on Tuesday. Again, we say, so what? Well, this is what one of the things that we're trying to do when we're going through the intensive, and one of the things that we're going to be focusing on during the summer intensive in there is teaching you how to think, or guiding you. But we really see that the intensive is it's a guide through the market's continuous two-way auction process. How do you learn to think about markets? If you're really going to compete successfully, you've got to get far beyond the point, where do I buy it and where do I sell it? You've got to be able to think and understand better what is going on in the marketplace. So when I looked at the 24th and I saw the difficulty the market had taking out the highs from those 2 days, from Friday and Monday, what it told me was that the chances were I was getting short covering and some day time frame or short-term buying, but if I had new strong money buying, I wasn't going to have that much trouble taking out those highs. So that, again, is very important information to take forward with me.
Can I make a comment there too, Jim?
No. Yeah.
A corollary to that, which we wrote in the report that night, was that if a market has that hard a time taking out, the matching highs, for instance, the odds of continuation after it takes out those highs has been lessened. It's reduced, that it's going to see some good continuation. Why? Just like Jim said, it's a nuance, but it's important. When you see a market struggling, trying to take out lows, hitting it again, finally it breaks through. Usually, it's not a day where you're going to see the home run. It's usually a day where it had to work so hard just to get it out. It grabs the stops below those lows or highs, and game over, side out, and it counter auctions in the opposite direction. So that's just a nuance I wanted to mention with bullet 4. Thank you.
And it's something we've talked about quite often. Again, it's learning how to think about the market, how to truly give yourself an edge. Okay, the next point. Market guns for all-time excess electronic high. Again, why? Because that's what markets do. Everybody knew where the all-time high was. They knew it happened Sunday night. Any trader, and remember, short-term traders are backed by, sometimes $100 million, $1 billion. There's a lot of money there. They know where that is, and once it gets within range, it becomes a self-fulfilling prophecy. That's what they see, and they shoot for targets that are very visual. And you'll see that markets are very game-oriented. That's why once those traders see that all-time high made in the Sunday night market, they're gunning for it, because then they just start They start buying and knowing they got enough power to get everybody else gunning for it. And then you got to see, once they get it, is there any more to it? So there's a lot of gamesmanship in the markets. You have to understand it. You have to accept it and understand markets are very visual. Once the all-time high is taken out, the market stalled for almost two hours. Again, let's go back and look at it and say, well, so what? Well, guess what? If the all-time high on the 24th was established as a result of new longer-term money coming into the market on the sell side, it is very unlikely that the market would have sat there for almost 2 hours before it began to break. Again, an extremely important piece of information, because that information has a lot to do with the potential on the downside. That information had a lot to do why I issued the warning, following the close on the 24th, saying that, hey, don't get so carried away with the, just because it's technically an outside day to the downside. How did it happen? It was probably liquidation versus a much more potent combination of longer-term selling and liquidation. The outside day of the downside is completed. Big deal. You have to look back and see, how did it happen? As Julia said earlier, what was played before and how that hand was played has a lot to say about the odds of downside continuation. We're going to talk later, so the market doesn't spill late. Again, so what? Well, if a market's really, as the market gets near the close, and when we get to the actual 24th, you're going to see that the market closed off of the lows. When it closed off of the lows and it didn't spill late, in other words, it didn't rally, and then one more swoop down late in the day, well, guess what? Most of the sell orders had been filled. Most of the sell orders have been filled. So that's a pretty good indication that maybe we're already done. Maybe we're done with that. Maybe we're done with the market. Now that becomes important information and thinking, because what you're going to see is overnight and just before the market opened in the morning, they were selling the market off to within one tick of the base of the spike from Fed Day. A lot of people that were price-oriented, boy, they were selling, and all of a sudden, they had the low for the day before the market ever opened. We never got to those lows. Again, let me bring up, and Julie, I know you got a question, but let me bring up again, one of the things that messes up traders and causes so many losses are so many traders are price-oriented. If you were just following price, you had price hitting the lows just before we opened on the 24th. You had price today, the overnight price, hitting new highs just before the pit session opened, before we took a big break to the downside today. Price is an advertising mechanism. That's all it is. And too many people are trading the advertising mechanism. You need to be able, if you really want to compete in this market, you have to be able to think about the market and what is going on. Julia, I know you were trying to say something or ask a question.
No, what does it mean the market didn't spill late? It didn't, and I know that it's when English is second, it gets confusing, but the market didn't break late. It closed pretty high, pretty well off the lows of the day.
A lot of times on a weak market, you'll see the market break. You'll see a little inventory bounce late in the day, and then you'll see a final swoosh down as the final sell orders, are coming in the market, closing on the low. We didn't have any of that on the 24th. The market made lows, it came off. We had no spill or another break to the downside late in the day. Another piece of information that says maybe the selling was all done. Okay, additionally, the next one, volume on that day was relatively low, 2.9 billion, relatively low for a day that went up, took out the all-time high, gave us an outside day to the downside, and our volume was well under 3 billion. Really not much going in there. What I've talked about is a lot of this information is why we issued the caution regarding the outside day. And now what we're going to do is we're going to go, even though I've talked about these before you see the charts in the profiles, I now want to go to the profiles. I want you to see the same thing on the profiles. So we're going to repeat it again. This is very important. I got an email yesterday, I think it was yesterday, and Cecilia, I want to thank you very much. And what it said was, thank you, Jim and Julia. Thank you. I'm a newer trader. Thank you for providing us the flavor to the market and the things that new traders really don't have any opportunity to know what to look at or to reflect on. And that goes for all traders. I've said many times, overnight inventory is so important early in the morning to know what it is. Most of the time, we said during the 60-day period, 65% of the time we had counter auctions. And recently it's been all but one day that I can remember in here. And I had very senior traders that had no idea the importance of overnight inventory. I was kind of surprised by that. Okay, are we ready?
Yeah, you can go to the next slide.
Okay. So here, the same things that we just talked about. Julia matched these up on the profiles. There's the poor high from Friday. There is the all-time high made in the Sunday electronic market. Poor high from Monday. So there's our matching poor highs. It's our overnight trade. So look at the overnight trade. The settle on Monday is the green line. We measure overnight inventory from the settle to the downside. So what was overnight inventory coming into the morning of the 24th? Overnight inventory was basically 100% short. If you look right below the green dot is the opening on Tuesday, and notice that we rally higher. So all of the overnight inventory people have to buy, that serves as fuel. Those shorts from overnight, that serves as fuel for Tuesday morning. So you'll see the A period, here it is broken out. There's A period, B period, and we're right up here to the matching highs. Notice we traded 34,000, 29,000, just below these numbers. We traded a tremendous amount of volume in here, and within a short range, trying to take this out. Once it was taken out, the market set its sight on the all-time high made in the overnight market from Sunday. Remember, Julia said earlier, it's when you have trouble taking out a high, that does not speak well for upside continuation. That doesn't mean you're not going to hit stop orders once you get above these matching highs. But once you got through here, the market then is the gamesmanship. It targets the all-time electronic high. Once that high is taken out, this is what I was talking about before. Notice this, the high is taken out. So we have, if you take a combination of C, D, E, F, in this very narrow range, which includes taking the high out, this is 2 hours between this, and it's an hour after it takes the high out before it starts to break. The point I was trying to make when we were going through the slides earlier, if you had an all-time, if you had all-time selling, if you had serious longer-term money using the opportunity to sell at the market's all-time high, it is very unlikely that you are going to sit there for almost 2 hours. If they were waiting to sell, they would come in there, and those of you that have, and we've got some clients on here that trade big money, they're hearing from the floor, Morgan Stanley's offering 1,000, so-and-so's offering 1,000, and they're starting to hear that those offers are out there, big size coming through. And when that market sits up there for that long, 2 hours, when it started to break, more than likely we were getting liquidation from all those that got so excited to get it up there. But not a combination, and I keep using this term, not a more potent combination of new money selling as well as liquidation. We were probably getting more liquidation. So the reason that I issued the warning was how difficult it was to take out this high, how long we set up here, and I thought this break was probably liquidation, and the market probably went from too long in the daytime frame to too short in the daytime frame. And if you look down here, there's the settle. It didn't close and spill to the downside. So these were all pieces of information. Did that have to be right? No. That didn't mean that we weren't going to go lower the next day. But again, I was approximating the odds. I was trying to figure out what is it going to take to get me to the airport on time to pick Julia up when she's flying in from Boston. You know, sometimes I'll be late, sometimes I'll be early, but I'm trying to make an approximation. I don't want to get there the day before, and I certainly don't want to get there the next day. I'm trying to be someplace within the realm of reality. And that's what this approximation does. These are the factors that go into that, went into that approximation in there. That's what trading markets is about. That's the type of thinking that you need to get to if you are really going to have a chance to be successful over a longer period of time. Now, Julia, I know you're ready to ask a question, but let me state one other thing first. It's very important. What I had written that morning, and I wrote a report following this day, and I used a term in there called sequencing. And for some of you that have been with me for a long time, it's the first time you've probably seen me use that term sequencing. The report that morning, was that night before, and that morning was written up, and I did it in linear form, and it was labeled conflicting information. I listed the things that said the market was going higher, the things that said the market were going lower. Now, before the day was over, all of it was, both the upside, the things that said we were going higher, and the things that said we were taking lower, were all covered. It was the sequencing in which it happens. And this is not uncommon. When you have conflicting information, sometimes if it takes it to the upside first, that doesn't mean that you're out of the woods. It may just take it to the upside, correct that business, or finish that completion, and then go back and look at the conflicting information on the other side. So the sequence in which things happen is sometimes very often. On this day, the sequence was, it started off with short covering by the overnight inventory was 100% short. We re-entered the previous day's range. We had all kind of information, and the poor highs up here. So you got short covering, and once it was over, and once they took out the high, that was it. It was game over, side out, and then we one time frame down for the remainder of the day. Julia, I'm sorry, you had questions.
No, thank you. A couple of these are good points that people are making, so let's go over it. How can you tell it was hard to take out those matching highs? Looking at the profile, price single printed past the highs in B period.
Okay. As I said earlier, as soon as we leave this, Julia is going to replay that day, and we're going to look at it. You're going to actually look at it trade. We'll play it real fast till we get there, but once we get there, we'll play it in regular time so you can get a feel for it. And remember, I pointed out the volume here, 34,000, 29,000 contracts in these two prices, just slightly below that level. And those were, at the time, those were about the highest prices of the day in this very narrow range. But you're going to see that when we go to replay. You'll see that in actuality. And a lot of times, you're saying after the fact as well, it's single prints. It went through there really easily. I can promise you it didn't. Another question or statement?
Yes, sir. And this is a good point too from Sam. He had made a mistake on the 24th, and he's saying he mistook the consolidation at the highs there as building value higher. Isn't spending time at the high, is that not a form of acceptance in value building higher?
Okay, it's an excellent question. It is a question of context. The market, you have that idea of completion. The market had completion. It went and took out the all-time high, and there was no immediate follow-through from that. So at that point in time, you could have said, okay, let's see what happens, and you could have gone with the downside breakout in G period. So you could have held this, and a place to put on the trade would be a downside breakout in G period. When I looked at this, and what I wrote up the other night and sent out to people that are already getting this, I said, normally I tell people not to lean into the wind. If the trade's worthwhile, you can be a little bit late on the trade. I was leaning into the wind on this trade because I really felt what was happening. Why? One, remember the matching lows. There's the low from Monday. The low from Tuesday was exactly the same as the low from Monday. So now,
So that's a negative. That's
a negative.
That's pointing to revisiting, because it wasn't aggressive buying off of it. It was responsive buying. That means there's short-term traders that are fickle and could be squeezed out in a shot. Just
buying, yes, absolutely.
Pardon
Buying
me.
exactly at the low from the previous day. So now, if I combine this low and this low, I have poor lows combining these 2 days. So that was a piece of information.
Overnight inventory too.
Well, that was part of the ruse. How trouble it had taking this out was important. And then once it completed, but I really thought it was just the game. It was the gamesmanship that goes on gunning for those highs. And I elected to lean into the market, and I started building a put position, a pretty good size, prior to taking this out. Now,
and leaning, Jim, pardon me, sir, just leaning into it means fading it, stepping in front of the train, as they say in some ways, and
correct.
fading it before it really is showing structure. Remember, Mind Over Markets 23 years ago, time is the impetus, structure confirms. But really, sometimes you have to have that sixth sense. When you wait for structure, your trade location is compromised. So,
But
Jim,
remember,
because of all these contextual things leading up to how that high was taken out, he was leaning into it, which he doesn't advocate.
But remember, I had poor structure here because I had
Right.
matching lows, so that's poor structure.
And you knew that the push-up was really the people freaking out from overnight that were covering because they were in trouble. So it wasn't necessarily new money buying. They were just underwater and needing to get out and cover.
Well, in addition to the game playing by short-term traders that are just trying to force the market to the all-time very visible high. It becomes self-fulfilling prophecy. They want to get up there because what's going to be right above that? Shorts. And that's what they're after. And that's
You mean stops.
Stops. I'm sorry, stops. Thank you. Stops. And what they do, they get together and they race the market up there, and when they hit those stops, guess what? Traders with stops there are getting the stops are getting triggered, and these guys are selling into it. The people that forced the market up there, that's why I say that was the game over, side out, and then we won. They didn't have any other game to play. Once they took that out, new money wouldn't be doing that. New money coming out of portfolios and things wouldn't have these poor lows. This was trading money. Again, those are the, when we go through things like the intensive and we go through webinars like this, it's not enough to read a couple books. It's not enough to just, draw some lines and have some references. You have to be able to think with the market. Remember, you are competing. If you're going to survive out there, you are competing with people that have been doing this for a lot of years. Now, you know, the ones that didn't do so well have dropped by the wayside, but as they drop by the wayside, you know, the ones that are left are pretty smart. And what we're trying to do, we're trying to give you information about what really goes on in the markets that you don't have. People that really know very seldom will ever share this information to you. They will tell you that these lines cross and this is red and this is blue, and they'll give you some things that sound easy. The easier they are, the less likely they are to work. If they were that easy, everybody will be doing them and they're arbitraged away immediately. Being able to think, a computer can't think like we're talking about here. And does this come easy? No, it doesn't. I've been doing this for a lot of years. But part of what we're trying to do through the intensives is teach you how to think. It's a guided tour through the continuous two-way auction process. Okay, Julian, questions?
Yeah, let's flesh this out, Jim. Do you also watch monthly or multi-month composite profiles while you are day trading? And if you do, what do you look for?
No, I do not. I mean, I used to. I do not. I take the market one chunk at a time. I look at monthlies, I look at weeklies, I look at daily, I look at monthly, weekly, and daily bars. That is how I speed read the market. That gives me a bigger picture of what really is going on and the trends. Then when I get down, and most of my trading is short time, when I get down, I narrow it down to statistical or to tactical things that I think are relevant right now in this marketplace. Part of the problem is I've had people all the time say composite profiles, and did I look at them at one time? Yes. And I find the problem with composite profiles, it take multiple days, they hide the important details. They'll hide gaps. They'll hide poor lows. They'll hide very prominent points of control. They hide the detail that I really need in order to understand and appreciate what is going on in the shorter time frame in the market.
Yes, thank you, sir. One logistical question here. Yes, we use 4:15 Eastern as the pit session close time, not the cash market at 4 p.m. The runoff in Chicago, or in the futures, I should say, 4:15 Eastern time is the settle for the pit session profile. And we also have the question, does Jim use the hour after as part of his profiles for overnight? Jim starts his profiles at 6 p.m. Is that correct, sir?
No, I use anything. Well, yeah, basically I start at 6 p.m. I'm aware of what happens afterwards, but I basically use, when the market reopens, is basically what I use for overnight trade.
I don't think there's any harm in using that hour after, Jim, 4:30 Eastern to 5:30. I mean, just put it in with your profile. I think it's marginal.
I don't think it's going to hurt anything.
Okay.
Okay, we're up. Am I right? We've got about 7 minutes left.
Yeah. Yeah.
Okay. So what I want to do.
And we're going to get to your question, Richard, regarding volume on the stretched out move in B on the 4th. Futures volume saw a decent pickup while the NICE did not. Does Jim consider this, or is this too much detail?
I'm sorry, what was the question?
Regarding the volume on the stretched out move in B period here that we're looking at on the 24th, he saw a decent pickup in futures volume, but the New York Stock Exchange cash did not pick up. Does Jim consider this, or is this too much detail?
I don't consider it. It doesn't mean I ignore it. I mean, I'm looking for blocks of volume and stuff like this. But
Not
I really
necessarily comparing it to NICE, though, on the, going back to the website.
We're going to run over. We're going to run over on today's webinar, but that's okay. What I'd like you to do now, if you can you take us and can we do the replay, and so I can show people, or you can show people, what it looked like as we were up near those highs? Yeah.
Okay. You can see my screen?
I can.
Okay. So here we go. Oops. Hold on. Let me. I have to do this. So what we're going to look at is the 24th. We'll play it at about 30 times speed until we get to it. So here we are at the open, sir. Let's see. I will make that smaller. Here's the open. We just opened. If you look up here, it's 9:31 Eastern. Okay? Go ahead, Jim.
Can you put a line across the matching highs?
Certainly. This was one, right? Was that it?
Yeah,
Hold on.
yeah.
Yeah. Okay.
Okay. Go ahead. Just let it play. You're in charge.
Go ahead. You can narrate. This is 30 speed.
Notice the confidence. Notice the green ball is the opening.
You know, I can, let me do something that'll make it easier to see price. I'm just going to set my window trader for last price. I turned it off to make these charts. Okay. And here's the settle too. I'll put that.
Notice this market's back and forth. Confidence is not high. Back and forth. There it goes. Okay, now. All right, now bring it down to regular speed. We probably went a little bit too fast because we've already printed that 34,000. Is it playing regular speed now?
I'm slowing it down. But the way that squirted up there in B, the way it just shot up, that is a sign of short covering also, that it just kind of lets go, and that's a panic. Okay,
Yes.
Go ahead. I will turn it on.
So those highs are even poor now because now it's traded there 3 days. Notice all that volume, and we're spending a lot of time there. It went one tick above it. It backs off. This is playing at regular time. So all those stops up there, and now it's traded, it's doing all that trading there. This is at regular time. So now the high is really poor because you've got not only the two matching highs, but this high on the 24th is only a single tick above those three. So it's even poorer than it was before. Poor high means there's lack of completion to the auction. But look how much trouble this market is having getting through that level. And that's what I wanted. This is what I really wanted you to see in regular time. That was a tremendously valuable piece of information to me. And when this thing backs off, you don't want to short it because now you got 3 days with almost similar highs, two exact and one back. Look at that market back off. They haven't taken. There's people selling it there. If you had, the point I was trying to make, when you're up at this high, if you had new money coming into this market, you are not going to spend all that time at that level. Julie, you were saying something.
Yeah, I beg your pardon, everyone. It's not showing. This is Friday's session here, this squat profile. I didn't have, well, maybe it was right. Okay. I don't know. It seems like it's missing a day, but I think I'm just getting confused. This is Monday. Okay, so
Friday,
here we have Monday. Yeah, I was missing.
Friday.
I was missing it. Okay, go ahead.
Okay. But you're still playing at regular time, right?
Yes. So here was Monday.
Remember, somebody said, but Jim, we have single prints. You had single prints, but look, it's after the fact. But if you look at how this is being made in here, it's really slow. And it's a lot of volume, and it's having a terrible time getting through there. This, there's all kind of information. But this area and the way it traded right here was my ruling reason that made me decide to lean into the wind, and I was pretty sure we would go take that overnight high from Sunday. But it's why I started building a put position on the way up. It's a lot easier to get them. It's a lot easier to get them when the market's going up than it is when the market's going down.
Right.
just this is agonizing how much time it's taking there.
And this is why, too, people have 1-minute charts, 2-minute charts. They want to see how the high was made or what have you. And Jim's saying, I use 30-minute charts, and I know exactly how the high was made. Why? Because he's watching it. He's paying attention. He's completely absorbed. I had no idea until I traded with Jim. Wow, you're really not, I mean, doesn't look at anything. He's watching it intently. Whereas, you know, some people have the 2-minute chart, look back at it. It's not the same. It's not like being there.
Remember the person that asked the question about the single prints, how fast it looked like it go through here? You see it in real time. Now you see the difference. And this is, again, what I say. If you're going to trade and you're going to compete in the marketplace, you want to be absorbed in the market. You want to be absorbed in the market. You're not taking emails. You're not telling your best jokes, you know, and stuff like that. You know, sometimes Julia will call me with something because she's not trading that day. She's working on business, and you know, maybe she's going over some detail or something, and I'm going, Julia, can we talk about this later? It's very important. She's not trading, and I am, but I want to see how it's made. And the same thing happens sometimes when Julia's trading, and I don't have a trade on, and you know, and I'll call her, and it's like, hey Jim, can I call you back? Okay, now, watch, this thing's been a long time. We're still only up to 13,000, and I think
what time is it? Yeah, well, 24, Jim, was also on the way back down toward the end of the day, so that was a tough read. You know what I mean? Because some of that volume that you were pointing to was from L period or K period. So we're now 10-12. We're only 12 minutes into B period, but that's still
it's a long time sitting at this high.
Mm-hmm. But it also, I would not want to be stepping in front and fading this, because you see this type of volume, and that is like picking nickels off the train track. You would not want to, it's too early. I mean, that's just getting cute and thinking, you know, because it's not seeing a sell-off of that volume either. So, I mean, I'm not saying I'd be accumulating a put position, but I certainly wouldn't be fading it yet, especially with the all-time high hanging out up there.
One of the things that Julia has done a good job of pointing out in the past is people that fade these markets. Well, you got 3 highs that are almost the same. It's not a market you fade. One of the things Julia has pointed out so accurately over the past is those people that are fading markets, they're adding the fuel that allow this thing to go higher. Because remember, every time they short into that thing, oh boy, they're selling at the high for the past 2 days. This has got to be a good trade, right? They're getting short, and guess what? They're going to have to cover pretty quickly. They add fuel to the coming rally in here.
Because they're buying, and they're adding, and it's,
they're not buying. No, they're not buying. They're shorting.
Well, they're covering their shorts, so they're entering buy orders and making the short covering rally. Even that, they're exacerbating the situation.
Right now, there's a lot of short-term traders that are shorting this.
Right,
market.
You can feel it. Yeah, they think they got it.
They think they got it because it's an exact high. It failed there 2 days, so they don't have an idea the idea that there's really no completion up here. So they're selling it, thinking this is great. And when it goes through here, they're selling 1 minute. They're going to be forced to come back on the other side. So you see this. This has been a long time in B period. It looks very narrow.
It's going to get ugly.
This was super information for me. You know, I usually not only did I build the position, or at least a lot of the position prior to the highs being made, I also did something I don't normally do. I added to the position twice as the market was breaking, taking this information and say they've got them really caught in here. Okay, we're still taking this. We're only what? How long are we into this period?
10:14 Eastern. I can speed it up if you'd like. I don't know when it breaks.
No, let's just stay. You know, if you have to go, you have to go. This is recorded, but it's important. It's important. The 2 concepts I want you to get here are: one, the lack of completion when you put these highs together, and this makes it even worse. Secondly, the people that are selling here, secondly, people that are selling here, they're going to be forced to cover here very shortly. It is a very poor trade for shorting, and as Julia said, once they get through here, those people that were selling in here, guess what? They're going to be buying in a few minutes to cover their shorts, and they're going to add fuel and make it even easier to get up there and get out the Sunday night high. But you know, you watch this for a long time, and you sit there and say, well, but there's nothing, there's no buyers here. This thing's been, what, 15, 20 minutes here? You say, wait a minute, why? And then it's hard to imagine that once it goes through there, it's going to go up and take out the all-time high from Sunday night. It's hard for your imagination to come to grips with that. But this, the one thing you do not want to do, you do not want to be fading this market. But you say, yeah, but it worked the last two times. Well, it didn't go very far. If you look at those last two fades, it didn't go very far.
Okay, now, yeah, let's just, he's new and he's signed up for the intensive. I know this is all coming at him full speed. But if you are seeing a poor high, why wouldn't that mean it should go higher to repair the poor high? Yes, you are correct there. It's a she, I'm sorry. You would, it is going to go higher. Then why would Jim be buying puts at that point? Well, that's why Jim uses options sometimes. You don't have to be as exacting.
Jim wasn't buying puts here. Jim was buying puts later after it got just short of the all-time high.
Okay, I thought you were accumulating your position once it came.
No.
You were waiting. Okay.
Oh, no.
Then maybe I had said that.
No. Once it got through here, and then I'd say they're going for the all-time high. And once they get just a few ticks short of the all-time high, what I'm thinking is because it's had so much trouble here, once they get the all-time high, it's going to be game over, side out.
Okay. Yes, I understand. Now, that might have been me. I might have made an error there speaking. Thank you for flagging that, BJ. And also, some people use a volume profile placed near the market profile. Is that important to have a view of the volume? Well, we do have the volume up there. You can see the volume profile. The volume stack to the far left is all trades, and the volume in between there is the current period 30-minute volume. So we do have the volume profile there, but Jim leans more on TPO structure that has the time.
That's correct, because the volume, it's time, price, and volume are the three components. I like the time. The time is important. I get a better feel using the volume profile. Other times people with the volume profile want to be more exacting and point exactly at the high volume tick, and that doesn't necessarily take time into account. It's not a do or die either or situation. You know, there's not one right, one wrong. I have a preference that I use the TPO profile, but I use the actual volume cumulative for the day and what's going on in the current period right next to me. Okay, how long have we been in this period?
Let's see, good question. 10:18. So we're at one speed, Jim, so.
Okay. So you see, remember somebody said looking at the single prints and it looked like it went through pretty fast. When you see it actually happening, it didn't go through fast. How long would you estimate it's been here? 10, 12 minutes right here at these highs?
Yeah, at least. Because it got up there pretty quick after the B period started.
It's been a
lot of volume. And think of the sellers that were selling this high, and they thought they had it. It wasn't going higher. It started going lower. I mean, they're trying real hard to press this thing lower, and they are
getting nothing. And there's
they're not getting it. And now it's like, watch when they have to start turning and running. Ooh,
you now have three poor highs. And as Julia says, once you get through there, those people that were selling here, they're going to contribute to taking the market to new all-time highs.
But then once, so Jim, you saw it tag and take out by a tick the all-time high, and that's when you said, or you obviously it came back into overnight range from Sunday night.
I was putting my position on before it got to the all-time high. Once it broke out of here and it got just a couple ticks short of the all-time high,
You started.
I started. I thought that was going to be, remember, if you draw a circle, say a semicircle, and you got, it goes from the left 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and then from the right-hand side you made the curve at the top, 12, 11, 10, 9, 8. You can buy all you want at 11 going up. Very hard to buy much 11 going down.
Right.
You know, it's...
They must have been cheap when they were still coming up. You must have gotten them pretty good. Sometimes you can tell that the market feels like it's going down because the puts will be expensive even though it's going higher. But I don't play that options game. I don't even pretend to know. But it's interesting how sometimes the options values can tell you a little bit. Okay, go ahead. I'm sorry.
See how long is it? How much time left in the period?
10 minutes left.
Well, 10 minutes left. Speed it up just a little. I mean, you've got the idea what's going on here. You saw how much. What I wanted you to see.
Okay, we're at 15 now.
How much?
Here she goes.
How much trouble it had. There it goes. Yeah. Okay. I wanted you to see how much trouble it had going through there. Julie was saying earlier some of that volume on the way down, but on the way up it was 31,000 and 23,000.
Yeah, that's pretty
within
huge.
a couple of ticks. Okay. Now, once they got through that, they ticked the stock. They got the stops, and they got through there. And those people that were shorting the market, they now have to buy to cover. Okay, and there the market goes. Now you see when somebody said earlier, when you look at this and you said, well, it went down there pretty fast, Jim. Not when you see it play for real, right? Okay, that's what I wanted you to. I wanted you to see how much trouble we had going through there, and the thinking I wanted you to get is, if the market really was that strong, you had new underbuying underneath the market, you weren't going to have that kind of problem going through there. All right. Let me have control back. Can I please?
Oh yes. Let's see.
Trying to
Here
get
you
control from Julia. Real tough.
See, I had to be convicted. Oh yes, here you go. Oh, yeah, look at that though. That's yeah, that was good. Okay. If
right.
you jumped in long at the bell, where would you have put your stop? At half back?
I don't know.
It depends.
I don't.
You probably would have been out when it was stutter stepping at the highs, even though it wasn't completed.
No, I
maybe not.
Not on that day, because I just
knew they were in trouble.
Well, the odds were it was going through. No, I don't know.
Yeah.
I have no idea where the stop would have been. Because
Right.
I wrote that thing up the other night for those that are already getting the reports for the intensive, and I must say for those who got the report, I was quite disappointed. I spent a lot of time on that report and a tremendous amount of information, really deep information, and I only got one comment on it. And I know that
He's more sensitive than he lets on.
Well, no, actually, it was worrisome because it's really the important information, tremendous amount of important information that really helps you become a competitor down the road. But I think a lot of times people don't quite appreciate the complexity of the information. Julia, before I do, well, let me do this final plug, and then I'll go and I'll look at the current market and talk about tomorrow. Again, we've been doing the 5 sessions, and we've done the 5 sessions, hopefully to impart real information, but at the same time we use them to do a commercial for the intensive that starts week after next, is it?
Yeah, Monday.
July 7th. July 7th to August 8th. It's a 30-day summer intensive. It's, like I say, 8 hours per week at least that I'll be live. And if something important comes up, we usually come in and put in extra comments. There's a chat box. It's only a one-way chat box, but I can make comments throughout the day that are pertinent to short-term trading on the market. Upon enrollment, you start receiving the 2 daily reports that I do. One at the recap at the end of the day, which in some cases recaps what took place today, as well as some thoughts and preparation for tomorrow. Additionally, what's really important, upon enrollment, you gain full access to the JD member archive, which over 100 trading articles and 50 webinars. Tremendous value for what you get in here. There's, a lot of time, there's 30, 40 years experience go into writing some of those articles. Anyhow, that's our commercial. For those, we've been exceptionally pleased by the number of people that have already signed up for the intensive, and so many new people. It's just outstanding. And we're doing a preparation for the intensive this Monday, but we're going to hold it right after the European close. And we're doing it because we have a lot of traders from Europe, Asia, Africa, all over, tremendous amounts. So we're doing it
Australia.
at a point in time that is more convenient for them. But of course, all are welcome. Let me at this time go to the current market.
And Jim, when you're on that, we've had a few people asking, was it a good high today? So just if you could address that, because there were several asking.
Okay. First of all, I will get to that question.
Can you show yesterday's? Okay, thanks. Just so we have a little context. Thanks.
I will get to that question in a second.
Roger.
First of all, remember the profile right here. This is actually the 25th. These days are offline. The profile right here we talked about. This was under the approximation with the anomalies down here. And when you see these anomalies, that tells you that the odds of going higher are greatly reduced. Doesn't mean it can't. A lot of things happen. But it tells you the odds of going higher are reduced. Now, this morning, when I wrote up the morning report, the market was trading right around the unchanged level from yesterday. And at that time, when I wrote the report at that time, I said, if we open within yesterday's range, I will probably let the market set up before I do anything. The biggest opportunities come when a market is out of range. And of course, the closer you are to the center of a profile, the lower the odds that you're going to get big trades that day. The further you're away from the center and the closest to the extremes or outside of the range, the greater the opportunities you're going to have. So I had no intention of doing anything early in here, and when I wrote this up. However, as we were nearing the opening, and remember we saw this on the downside the other day, how wrong people were. As we were nearing the opening in the electronic market this morning, I elected to sell some futures. And why did I elect to sell futures? Simply from the price-based opportunity. It's coming up here. If it goes much above the high, I'll be out. But I'm sitting here saying, this is kind of nuts. Now they've gotten the overnight inventory somewhat long. I've got these anomalies down here. So I got pretty lucky, and I sold someplace right up in here. And of course, the market sold off immediately this morning. Sold off immediately. And remember what we said earlier, and I think Julia brought this up. When a market moves very quickly, either up or down, if it's going up, it's probably, as we had over here, big A period run, it's probably short covering. When you see this, it is probably liquidation. Liquidation is different than a combination of new money selling and liquidation. The market failed at the high. The short interest, remember there was a lot of short covering yesterday. That's what I think all yesterday was. It took a lot of the potential buying power out of that market. So when this market started to fall this morning, all of this potential buying power had been removed. Now, we looked down below yesterday's low, and people know, I've said it in seminars that you've been in with me, when a market looks below a previous day's low and comes back in, the hair on the back of my neck stands straight out. And, and that's, we looked below yesterday's low, we came back in, and we never got any single prints down below yesterday's low. The shorts are trapped. The market got liquidation, and you got too many people jumped on it, and the market got short and probably spent the rest of the day in a short covering mode. Now, there's several things. What I have been writing for the last couple of days is be very careful. There has been a tendency in the last few quarters for stocks to get marked up to make portfolios look better, coming into the end of the quarter and finding those markups taken back a couple days after the beginning of the new quarter. It's another, you know, I said earlier, there's a lot of gamesmanship goes on, and you can pretty well guess when we've had several quarters of this, when the market rallies going into the end of the quarter and falls right after the quarter, guess what? Portfolio managers get paid on performance. The higher the market is at the end of the quarter, if their assets under management will be larger, and if they get performance fees, that will be larger. So you take your guess. I can't prove it, but I suspect that there's some artificial marking of prices going into the to the end of the quarter. So I'm a little unsure as what we're dealing with here, because here's what I wrote this morning. This was the bluer line here was value and the new all-time high from Tuesday. Wednesday had overlapping to slightly lower value. And then what I wrote up last night was if value basically overlaps yesterday, the market remains balanced. If value is overlapping to higher or higher, then all trends remain up. And if value is overlapping to lower or lower, then the short-term trend is to the downside. Now, technically, today's value is, there's today's value. Let me mark, there's the top of yesterday's value. There's the top of today's value. So technically, today's value is overlapping to lower. However, because of the strangeness of the day, I'm neutral right now. What I'm going to do for tomorrow, I'm going to treat this as a single distribution down here, and I'm going to treat anything above 1944.75 to the high as my second distribution. So I treat the distribution as a separate day or auction. So I want to see in the morning, am I in or out of balance? So if I trade tomorrow and I start building acceptance above this distribution in here, then it's pretty positive. We're going for the highs again. If I start to build value down below this distribution back in this, then the market's fairly negative. So, you know, I'm a little bit neutral right now. That was quite a rally today. I know it's quarter end. You can get some very, yesterday was the last day stocks could be bought for this quarter settling regular way. There's other people can sell for cash or can buy for cash. There's other ways to do it, but the end of the quarter is technically Monday. So we're in a kind of a not so sure area right here. So basically for tomorrow, I'm going to treat from 1944.75 up to today's high at 1951.50 as my upper distribution, and I'm going to treat from 1944.75 down to the low as my lower distribution for tomorrow. So I treat this as a double distribution day, even though technically it's not, but I'm going to treat it as a double distribution day. I'm treating each distribution as a separate day or auction. So I'm taking from 1944 up to the high 1951.50 as a separate day. Am I opening in or out of balance relative to this day? Do I build value higher or lower relative to this day? That's what I would be looking at for tomorrow. Building higher value above this is positive. Building below this and below 1944.75 is negative. Julia, that completes the formal portion, but let's take a couple more questions.
Let's see.
My feelings aren't hurt if there aren't any.
No, there's just a lot. It's just that we had a question earlier about the naked POCs, and a naked POC is a point of control that is not revisited in the next day. And how does Jim, sorry, these guys are doing work outside. How does Jim feel about?
I classify POCs as prominent and very prominent. And don't ask me how wide prominent is and how wide very prominent is. Very prominent is very wide, prominent is wide. I don't know the exact count. You learn that from observation. But generally in the S&Ps, it'll probably be, 7 or 8 wide. But and the really prominent will be 12 or 13, but I don't know exactly. But the only ones I carry forward and keep track of are the prominent or very prominent POCs. If they haven't been revisited, again, I'm very much aware that if I break below today's low again, I have a prominent point of control down here at 1933.50 that has not been revisited. Notice we had one down here, it got revisited. It's amazing how this market went up, it came down, and it does get revisited sometimes. Okay? But I carry them forward.
Yes, I'm sorry, I didn't mean to interrupt you. Brian, also, and for people, I feel like I mentioned this article a lot, but it comes up a lot. There's an article available to everyone at the Resources Trading Articles, Article 80, Forcing Action. And we just happened to pull a week of the S&Ps, and we wanted to write about it, and it shows how many times these prominent points of control are revisited. Maybe not the day after, but they beckon the auction back many times. So that's an article that that's there for you to learn a little bit more. And it's cumulative, right? You start to see multiple ones.
Yes, one point of control that's not been revisited, one data point. 2 that haven't been revisited that are prominent or very prominent. It's an exponential calculation. The odds increase substantially. The rally we had in Chicago we were talking about earlier probably had 5 prominent points of control that hadn't been revisited. Okay, 2 more questions.
Question about the overnight inventory. Does Jim consider today's overnight session too long or too short? I heard him say it's too long because of what happened in the last period.
Yes. When I wrote it up this morning, and I think I did the report at 8:34 Eastern time, because I usually wait till there were some scheduled announcements this morning. I usually wait till those come out, and at that point in time, I basically considered the overnight inventory as balanced. By the time we opened, I saw the overnight inventory as having gotten long, not major long, but net long.
Okay, and yes, that article is Article 80, Forcing Action, talks about prominent points of control and other type of poor structure and how they are revisited. It's Article 80, go to Resources and Trading Articles, and there's a whole list of them there. The ones that are green you can see, and we did make that available for the public. How do you know if overnight inventory is too long or too short? Take the settle of the day before the close. Does the majority of trade happen above it? It's too long. The majority of trade happen below it. It's too short. Okay, Jason? And we might have a glossary term there, or there are some free webinars that talk about overnight inventory and the importance of it for daytime frame traders.
Thank you very, very much. We've gone over about a half an hour. But,
one other one, Jim, real quick. I beg your pardon. People are asking what is the intensive online session schedule. If you go to the intensive details page, which is under programs, 30-day intensive, there's a schedule there that you can download to see what we have planned for daily sessions to give you an idea of when those 8 hours happen. Jim usually plugs a few more in. If he were watching the market in the morning and he says, this is an interesting morning, I'd like to come back on this afternoon if we can all make that. So we'll add some here and there. But that will give you the framework of what we'll be looking at for the 5-week period.
And you may have guessed from just the 5 free sessions we've done here, I hold nothing back. There's no information that I do not share. It doesn't mean I do it all right or I remember it all, but there's no games playing. Sometimes people don't like to give you their trade secrets. I don't think there are any real trade secrets. So we try and share with you all information we have, and we take a tremendous amount of pride in hoping that we do impart value and do share with you information that you're not going to hear anyplace else. So once again, if you haven't signed up, we would love to have you, and thank you very much. Julia, thank you.
And thank you, Jim, and we appreciate it very much. I know I do, and I know a lot of traders here are saying thank you. And thank you, everyone, for being here and taking the time with us. And I'll get this webinar uploaded to review it if you wish. Okay, and everyone, God bless you and have a wonderful evening or day wherever you're at. Okay, thanks. And thank you, Mr. Dalton.
Thanks. Bye now.
Bye-bye.